In this video, we're going to talk about the corporation. And in general, we'll talk about two things. We're going to talk about the types of business forms, and we're also going to talk a little bit about taxation. So let's think about the forms of business that are available. I mean, there are basically three forms: sole proprietorships, partnerships, and corporations, and a new form that has been developed called a limited liability company, or LLC. Now, of the three primary forms, the other forms, and there are more than LLC, there's subchapter S, there are small corporations, there are partnerships that are limited partnerships, there's a variety of types of forms. They are mostly a combination of the characteristics of the three primary forms. As you can see from this graph, that the vast majority of or percentage of businesses are sole proprietorships. Corporations, which we think of that's business, is really only 18% of the total number. But what is important is to recognize that corporations provide the greatest amount of revenue. 82% of all revenue is created by corporations, where sole proprietorships only create 4%. So, although it's not part of this course, I think it's interesting then to try to understand when the government makes tax changes, when the government takes action to encourage business, who should they gear that towards? What entity is going to create the greatest impact on taxes, for instance? You would think that they would want to gear it towards those businesses that pay the most taxes. And in total, obviously, that is corporations. So a sole proprietorship, I don't think we need to talk in a lot of detail. Essentially, you understand it's run by one person. It's pretty easy to create. There's really no separation between the firm and the owner. And we'll talk about this maybe a little bit later. But if you think about the assets of a company, in a sole proprietorship, the world looks at the business assets and the owner's assets as being belonging to one entity. So where this comes into play is the concept of unlimited or personal liability. If the business is sued, what assets are at risk? And for a sole proprietorship with unlimited liability, all the business assets, which includes the owner's personal assets, are all at risk. So if you have a rather risky business, you probably do not want to be established as a sole proprietorship. And of course, since there's only one owner, the lifespan of the business is the lifespan of the owner. Now, the only thing that we can say that might be a bit more of an advantage that's not mentioned here is taxes, because taxes are taxed or are assessed at the individual's tax bracket. Partnerships, again, similar to a sole proprietorship, except we have more than one owners. All these partners are personally liable for all of the firm's debts. So again, probably the worst person to be would be the wealthiest partner, because you have more assets to contribute than anybody else. And of course, just like with the sole proprietor, the partnership ends with the death or the withdrawal of a single partner. Now, there are two kinds of partnerships. There is a general partnership and a limited partnership. In a limited partnership, the partners are categorized into two types. General partners have the same rights and liabilities of partnerships in a regular partnership. They run the firm on a day-to-day basis. So this is just the partnership example that we just briefly talked about, where all of their assets have unlimited liability. Now, limited partnerships or limited partners have limited liability. They cannot lose more than what they've invested in the company. So if the company is sued, the assets, the personal assets of limited partners are not at risk. Now, one of the rules then, though, is because you get these special risk adjustments, if you will, so that you're not at risk, you're not allowed to have any management authority. I like to think of limited partners as being silent partners. All they do is provide money. They're not allowed to manage the company. They're not allowed to have any influence on actual operations, the purchases of assets, etc. Now, a limited liability company, all owners have limited liability, but they also can run the business. So this just says, look, essentially you're a limited partnership, but there's no general partners here. Now, taxes are determined obviously by the tax code for these limited liability companies. We'll talk about that as we discuss a little bit more in this video. Now, a corporation, as you probably are aware, you have all the legal powers of people, right? About the only thing you can't do is vote. And the corporation is solely responsible for its own obligations. In other words, a corporation has limited liability. The assets of the business belong to the corporation. The assets of the owners are separate and distinct. Essentially, we form these in a state where you provide a charter. Because of the legal environment for corporations, many corporations are incorporated in Delaware. As far as the ownership, I think everybody is aware that it's represented by a share of stock. So again, you're going to be a shareholder, stockholder, equity holder. Again, the sum of all this value is called equity. There's no limit to how many shareholders you can have. So therefore, there is essentially no limit to how much money the company can raise. Now, of course, ownership has rights. One of the things you're entitled to are the profits and or the dividends of the company. So again, coming back to this concept of business assets, I think it's important just to kind of review this, since it's one of the primary things that's going to drive the type of business form you want. So the simplest definition is the assets of the business are what is used to produce revenue and resources. However, for partnerships and sole proprietorships, the definition is different. Refers to the assets of the owners that are risk should the company encounter challenges like bankruptcies or liabilities. So the business assets of a corporation, if you're an owner, is the common stock. So the only thing you can lose if you buy a corporation is the common stock itself. But the business assets of a sole proprietorship or partnership include all personal assets. So again, liability talks about being sued, and we've mentioned a couple of times there's either an unlimited liability, which means everything is at risk, or limited liability, which means only the invested capital is at risk. So how do we choose what form of business we want, right? In reality, sometimes we really don't have a choice, right? When you choose a kind of company, sometimes it drives us to the right choice here. But the factors that should be important to us are, number one, risk and the liabilities that we may be subjected to. Funds availability. Can we get money if we need it? So if you're in expansion mode, you want to have as many people that can help you as possible. So maybe you shouldn't be a partnership where it's difficult to find those people with lots of money. Maybe you should be a corporation. With respect to taxation, obviously we want to keep as much money as we possibly can. Thinking of the owners pay taxes of their own when they receive dividends, but since they own the business in a corporation, the corporation also pays taxes. So in a corporate setting, the owners actually pay taxes twice. And finally, a pretty important concept to think about is control, right? I mean, why do entrepreneurs want to open their own businesses? They want control. They want to control their destiny, if you will. So, do you want to share control? If you don't, then you would never want to be a corporation or a partnership, because that means control is distributed to others. We mentioned the tax implications. Double taxation is an issue if you are an owner of a corporation. One of the things I did mention a little bit earlier is something called an S corporation. The firm's profits in an S corporation are not subject to corporate income tax. They're just allocated just like a partnership. So an S corporation acts like a partnership, but since it's a corporation, the owners have limited liability. One of the other things with S corporations is that the how you create them is essentially free. It is done through a tax form. So you don't really have to even incorporate. You just file a reform with the IRS and you become an S Corp. So again, there's lots of reasons why these different forms fit for different kinds of businesses, different types of owners, etc. So let's look at a problem, if you will, of how this taxation issue appears for us. So if you're a shareholder in a corporation, the company earns $8 per share before taxes. So the corporation has to pay taxes. If the corporation is in the 25% tax bracket, 25% of $8 is $2. The dividend income is income to the owners. So if the entire earnings was distributed, the owners would have to pay taxes on that entire amount. So the corporate tax is 25%, dividend income tax is 20%. So the taxes on the distribution then, since $2 goes to the government for their corporate taxes, that means there's only $6 left in net income. That's $1.20. So the taxes paid is $3.20. So the effective tax rate for a corporation is 40%. $3.20 was paid on $8 worth of income. What if it was an S Corp? In this case, the dividend income or your non-dividend income is 20%. So now, if you earned $8 per share, you're going to pay a total of 20% of the $8. So 20% of the $8 is $1.60. $1.60 obviously divided by the $8 is 20% tax rate. So in an S corporation, since all the income is accumulated into one pile, the effective tax rate at the S corp rate is 20%. So again, for an S corp or for a partnership or for a sole proprietorship, the taxation on this $8 is only 20%. So the difference between 20% for partnerships and sole proprietors and the 40% for corporations hopefully is an indication that the taxes to owners of a corporation are much higher than the taxes to those of sole proprietorships. So again, the basic idea in this video is, how do you decide what kind of business, what form of business do you want to create? See you in the next video.